Good morning and welcome to Bazaar Morning Call. I am Anuj, with me, Prashant and Sonia as always. And well, we are looking at a wonderful screen for the global markets. Not that as it matters to India, but it's only a bonus. And the global markets go down, our markets go up. Global markets go up, our markets go up even more. So what more can you ask for? The US market, of course, ended at the highs after starting with big cuts. So big intraday rally in the US market. And of course, the Indian market has ignored the negative global cues, but it participates on the upside on positive cues. The Nifty will test that trend line once again. So that's going to be important. And the big question is, not today, of course, but going forward, can this 18,000 mark be conclusively broken? The SGX Nifty is indicating a big gap up. 150-point gap up is as big as they come. Prashant, Sonia, hi, good morning.
Hi, Anuj, morning. Hi,
Good
Prashant,
morning.
morning.
Best of both worlds, right? Ignore the downside and participate on the upside.
Participate on the upside. And yesterday, the market recouped its losses, and how, right? I mean, financials were leading from the front, autos, FMCGs gains. So I guess this buy on dips philosophy is something that continues through the course of this year. But having said that, it is a strong global market. No two ways about that. Good going on the Dow. The US Fed meet kicks off today. So like a broken record, we're going to tell you that 75 basis points rate hike perhaps is already priced in. 100 basis points is something that the street is bracing themselves for. The 10-year yield ended at 3.5%, which is the highest since 2011. But I want to talk a little bit about what's happening on the corporate side of the U.S. because, a couple of days ago, you heard from the FedEx CEO where he spoke about how there are concerns with regards to recovery, growth, etc. The latest now is what's happened with Ford. The shares were down about 4.5% in after hours, where the management said that the supply chain issues that they faced will cost an extra $1 billion in this quarter. So there are definitely concerns that corporate USA is facing, and don't lose sight of that. For our own markets, of course, things have all been hunky-dory. Yesterday, the FIs bought about 300 crores. DIs sold a tad bit. The next 2 days, the next 48 hours could be, a bit of ebbs and flows, given that we have a big event upon us. But give and take everything, this has been a rising market, and there's no two ways about that.
In this market has rewarded you for not doing anything. If you're tempted by every small move here and there, then you may have lost money, actually. And if you're just done the simple thing of buying and sitting tight, I think this market would have really handsomely rewarded you. So, yeah, I think for me, the big data point is the FII data in the futures and options market. This is something I've been talking about for the last 2 or 3 weeks, that, you have a lot of shorts in the system, and these shorts are just not getting any follow through. So, do they throw in the towel? I think yesterday was the first sign that these shorts have said, okay, enough is enough. We are not getting any traction. Let's just get out of them. Yesterday, in fact, if you look at the longs and shorts, FIs have covered shorts by almost 13,000 contracts. Why is that important? Because the net short is now down to 45,000 contracts, which is still on the short side, but almost half of peak. Now, let's see if, they're still at 68% short position. So, at some point, maybe even this has to cover if the market keeps going up. And X of IT, the Indian market is at all-time high. I mean, if you look at the bank Nifty, that's at all-time high. Auto index is at all-time high. FMCG index is at all-time high. You've seen what cement has done in this market, what infrastructure has done in this market, all of them at all-time high. The only logical trade in this market is buy the dip, but in the economy-facing stocks. IT rallies will be tempting, will look good, maybe like today, but while they'll be powerful, they'll be short-lived, because this is a market in which there's pain in the US, but domestically things are looking quite good. The only risk that I see, Sonia, not in the near term, but in the medium term, is if we keep ignoring this global risk off, and if we keep ignoring recession fears in the US, because at the end of the day, if our IT companies get hurt, that also impacts our macro in terms of balance of payment, in terms of our reserves. So I think that is not in the near term, but in the medium term, that will emerge as a bit of an issue. Just one last point for day traders: 5-day and 10-day exponential moving average 17,725 and 1750. That's the range that I'm working with. If we start to trade above that, then maybe more short covering. Prashant, hi, you got your glasses back.
I have my glasses back. Well, purely ornamental.
So that you can finally read through the US Fed speech. You're prepping yourself for that?
That's tomorrow. That's going to be tomorrow, Thursday morning, right? Yeah. So Thursday, that's Thursday morning for us. But, anyway, the point is that the global is starting to matter lesser and lesser. I don't know if it's a good thing, it's a bad thing, but that's the way it is. The rally in the US basically overnight came in the last 30 minutes or so. I mean, it was a Sharp move higher, and it was led by large cap mega tech names, right? So the Nasdaq, for example, did better than the S&P. It was up 0.76%, and the S&P was up 0.7%. What kind of caused this rally? You can't obviously pinpoint on any given day, this is it, what caused the rally. But there was a Bloomberg News report which basically said that in August, housing demand in the US perhaps is it fell sharply. Now, housing is one of the first indicators, or at least a very important indicator to signal whether the economy is doing very well or it's slumping, right? And on the back of this, expectations that maybe the Fed will not be as hawkish as what it told us during Jackson Hole, that 7-8 minute speech. I mean, I think that came to the forefront. So this is, I mean, arguably, if you want one data point, what caused that last 30-minute flourish in the US. And as a result of that, I already indicated what equities did. Yields, which were the 2-year, for example, had spent bulk of the day above 4%. It came off under 4%. It's about 3.95 or so. The 10-year, which was above 3.5%, it finally left off at about 3.5%, just under 3.5%. The DXY index, which spent a lot of time above 110, it fell to about 109.6 or so. So all of this happened in fast-forward mode in the last 30-40 minutes of trade. But post-close, post-US close, you had this from the Wall Street Journal. The Wall Street Journal, the economics reporter, is called sometimes as the Fed whisperer. And he wrote an article and he pushed quite strongly against any potential dovish outcome in his article. This came out post-New York close, post-NYSE close. So keep that in mind. I mean, I probably would have put some of the stuff what he said. He said he quotes Powell and says the clock is ticking. If you let inflation run high, households are going to adjust to these high levels of inflation and start to act accordingly. We don't want that. We want to avoid that outcome. So the clock is ticking. So, I mean, this happened post-close. The point is, I mean, if this was a regular kind of market where global cues mattered, and right now they don't, I would have been very surprised to see the SGX indicating the kind of opening it is indicating, or the bulk of Asia, which is, I think, in the green, not wildly or anything, but there's more green than red. This would have mattered. For now, I mean, this is not. That's where we are at right now. SGX indicating a 150-odd point higher start. We'll pick up from there. And that trend line that Anuj spoke about from the all-time high, October 2021, all-time high of 18,604. I mean, I think there's going to be a test, a knock of that once again. Sonia.
Oh, absolutely. And we should keep the cautious